This is the Door Roll of Money podcast. I'm your host, Rob Berger. In episode 365, we're going to talk about three things. First, how to handle credit card debt in your budget, and in particular, in a budget app that you might use. Then we're going to talk about a very simple way you can maximize the returns on a mutual fund or ETF that you may own. And then thirdly, we're going to look at the power of subtraction. So I hope everyone's having a good week. My week is so-so. I played in the World Open, which is a chess tournament in Philadelphia over the 4th of July. They have it every year. It's always over the 4th of July, which kind of is a bummer because, normally I'd like to be with family watching fireworks. But they have, they've been kind enough the last couple of years to let me go play. It was a rough week. I basically go and I get beat by 12-year-olds. That's basically what happens. This is a big tournament. There were about, 1,000 chess players there, maybe more. I was playing in boards around 300, so, that would be times two, of course. 2 players per game, so that's like 600 people. But there was a whole nother floor of, boards. So, yeah, maybe more than 1,000 players. One person of some kind of fame was there, Hans Niemann. He's the grandmaster that got into that brouhaha with Magnus Carlsen and the whole alleged cheating scandal. Did he cheat or didn't he cheat? And then there was a lawsuit. It got dismissed, but I don't know that the case is over. He was there, a phenomenal chess player, by the way. And I don't know how he ended up doing. I know he lost a game or two. But anyway, yeah, it was kind of a tough week because I won 4 games. I lost 3. I drew 2, which may not sound horrible, I guess. But every player I played was rated significantly below me, lower than my rating, which means even though I won more games than I lost, my rating went down pretty significantly. But the more important thing was the 3 games, and actually in every game, but including the 3 games I lost, I had a significant advantage, really a winning advantage. And of course, for 4 of those games, I ended up winning. 2 of them I drew. 3 of them I lost. One game I had really just an overwhelming advantage. And towards the end of the game, I moved a knight, and he took it. I moved it to a square where he could just take my knight. Here's a knight. Good luck and Godspeed. I don't know. I'm getting old. I don't know what it is. Anyway, hopefully you had a good 4th of July. All right, enough chit-chat. Let's get to it. So, the first topic today, and by the way, you've noticed over the last few episodes, I've done this sort of 3 different topics per episode. I hope you like it. I kind of like it. But I guess more importantly, what do you think of it? And what topics would you like me to cover? If you want me to cover something, send me an email, dr@doorroller.net. Be happy to tackle any of the questions you might have. So this first one, this was actually something that stumped me back in the day when we were trying to get out of credit card debt. And I was trying to figure out how to budget because we had 2 things going on. We had some existing credit card debt. At the time, it was mainly 0% interest credit cards that we were just paying on each month to pay it down. But then we had just our ongoing monthly expenses, many of which we would put on a credit card and pay it off at the end of the month. And I was trying to figure out, how exactly do I work all of this into the budget? Should I just have one budget category, just, credit card payment? And I guess it would change a little bit from month to month, depending on how much we were paying off from just our regular spending and how much we were paying on the sort of existing credit card debt. And then one day it just clicked that I was doing it all wrong. And it's really, I think, a fairly easy but important way to handle credit card debt. And you need to think about credit card debt in 2 buckets. The first is existing debt that you've had and you're just trying to pay it down. So that's bucket 1. And then the other one is your monthly spending. If you're putting on a credit card, we do now, partly for convenience, partly for security, but also for the credit card rewards. And we're paying it off, in full each month. That gets treated differently. So how do we do it? So for the existing credit card debt we're trying to pay down, that is a budget category. Credit card payment. You can put it, depending on the app you use, you can actually enter it as a debt. And some apps like YNAB, I think, does it this way, has that debt category, and you can have a plan to pay it down. But it is a monthly category item, credit card debt, and a monthly payment, whatever that payment is for you. And in that sense, it's not treated much differently than a car loan or a student loan or a personal loan. You got a balance, there it is, and you're making a set payment typically. Of course, with credit card debt, the minimum payment goes down as you pay it off, but hopefully you're following either the debt snowball or the debt avalanche, and you're paying some sort of fixed amount every month regardless of the minimum payment. But in any event, that's treated as a debt. And then with the spending that you're going to just pay off every month, you go to the grocery store, the gas station, a restaurant, you put something on a credit card, you pay it off at the end of the month. Those should be treated as categorized based on how you spent the money. So for most of the apps, you connect not only bank accounts, but you connect your credit cards, and those transactions get pulled into the budgeting app. Again, that's YNAB, Quicken, Simplify, Empower, or Personal Capital if you use their budgeting tool. And you connect your credit card, and it just downloads all of those transactions, and it's the credit card transactions that get categorized, not the payment at the end of the month to the credit card company. But the individual transactions on the credit card, they get categorized again as groceries or gas or whatever. And then when you actually make the payment, this was maybe I'm just slow and you guys have already figured all this out, but this stumped me for a while. It's like, well, wait a minute. Okay, I get that. But then at the end of the month, when I make my whatever, $1,000 payment or whatever it is to the credit card company, that's money coming out of my checking account. So I got to categorize that somehow. How do I categorize it? And the answer is you don't. It actually gets, I guess you could say it's categorized as a transfer. You're transferring money from one account, your checking account, to another account, your credit card. It's a transfer. And I think pretty much all of the budgeting apps today, and I've tried just about every single one of them, including, by the way, Tiller is another one, it has a transfer, I guess, function. So when you go to input the quote-unquote category, one of those categories is just called transfer. And when you then look at reports from your budgeting app, like let me see all my spending for the month, it won't include that transfer. It will include the individual transactions that were on your credit card and however you categorize those, of course. But the payment from your checking account to the credit card company that you've marked as a transfer doesn't show up in the expense reporting. And that was the key. And that's at least how I've always handled credit cards. Now, today we don't have credit card debt, beyond, what we pay each month, paying the credit card in full. So this goes back a number of years. But that's how we handled it eventually once I figured it out. And again, maybe I'm just slow, but I think that's the right way to handle it. I think all of the budgeting apps today handle it that way. And I came across this issue actually on Reddit, and some folks were asking about how to handle all of this. So I thought I'd mention it in today's podcast. So hopefully that might be of help to somebody. So that's number one. Number two, how do we get the most returns out of our mutual funds and ETFs? And that question may seem like an odd one, right? It's like, well, I don't know what you mean, Rob. I mean, they're going to return whatever they return, and there it is. And there's nothing we can really do to increase it. But it turns out it's actually something we need to avoid doing that can help us get the most out of the returns from mutual funds and ETFs. And I want to mention an article. I'll show it on the screen here for those watching on YouTube, but I'll link to it in the show notes as well. And it's a study that Morningstar puts out every year called Mind the Gap. We're actually looking at an article about that study. Now, this is from last year. I don't think the 2023 study has come out yet, but it's okay. This works great. And we're looking at a chart now. And what Morningstar did was say, okay, we know what a fund or a fund category returns. We know the returns. It's just data. Look at the history. But can we figure out what investors actually earned? And you say, well, wait a minute. What? I don't understand. Why would that be different? And let me do some. There we go. There I am. Why would that be different? Well, it's because we tend to time the market. We go into a fund, we leave a fund. If things aren't going well, then it starts to do well again. We jump back into the fund. And so Morningstar sort of looked at those cash flows in and out of mutual funds and ETFs and calculated what they call an investor return. So here's the total return of the fund, but here's what the investors earned. And the numbers I think, tell us a lot about investor behavior. And just to give you an example, if we think of like US equity, so an S&P 500 total stock market, the total return, and this was over 10 years, was 15.86%, which by the way is just extraordinary. I'm not expecting another decade like that for a while, but 15.89% was, 15.86% was the return for that category. But investors only earned 14.67. They lost over 1.19% of the return because of the cash flows. Now, I suspect some of the cash flows were for good reasons. Maybe you're in retirement, you need to pull some money out. But of course, for a lot of folks, it's market timing, right? What I found interesting beyond just that is that the amount of money that investors lost varied based on the type of fund. So for example, the type of fund that where investors did the best was called an allocation fund. You can think of a target date retirement fund would maybe be considered an allocation fund. Certainly a balanced fund like a life strategy fund from Vanguard, where you invest, depending on which one you pick, it might be 80% stocks, 20% bonds. But that sort of fund, a lot of folks will use it as sort of their only investment, right? Because they can sort of get total diversification in a single fund. That one only lost 77 basis points, 0.77%. The total return was 9.43%. Now keep in mind, this type of fund is going to have bonds in it. 9.43%. The investor return was 8.65%. All right. So not bad, I suppose. The worst type of fund, the one where investors did the worst as compared to the total return, is a sector equity fund. You know, there are sector funds where you can invest in tech, for example, or healthcare, right? Listen to this. The total return for those types of funds over the 10-year period, this is as of last year, 13.84%, but investors only earned 9.59%. They lost 4.25% because of their buying and selling in and out of these sector ETFs, typically, I think. That's a significant loss, and I think there's a couple of takeaways from this. First of all, timing the market just doesn't work. Notice, by the way, in all of these, and they list, I guess it's about 8 different categories: allocation, alternative, international, municipal bond, non-traditional equity, sector equity, taxable bond, and U.S. equity. Notice that the timing, the market timing, never results in a positive. There's no situation here where the investor return was higher than the total return. It was all negative. And I think it underscores something that I think most of us already know, and that is timing the market is a loser's game. It's almost impossible to increase your long-term results by trying to time the market. But the other thing it tells us is there are certain types of investments that I think investors are more prone to engage in market timing. The sort of allocation fund, sort of one fund, buy it and sort of set it and forget it. Yeah, there's not a lot of market timing going on there, at least compared to some of the other types of funds. But a sector fund, an equity sector fund like tech or healthcare or what have you, I think lends itself to more buying and selling. I mean, I can't tell you how many emails I receive from folks saying, do you think tech is hot right now? Should I get into, how about oil and gas? There's always some hot sector that people all of a sudden get interested in. It's gone up in value, so they dive in. And then eventually, as it always happens, eventually it goes down, they jump out. And the result is they're buying high and selling low. And so that's why I think in these reports, you see the sector equity type of fund with the widest gap between total return and investor return. So I think there's kind of 2 takeaways. One is, again, market timing doesn't pay. We want to buy funds and stick with them. But the second thing is, because I get this question a lot, like, what's the best allocation? How should I invest my money? And there's no one right answer to that. But part of the answer is you need to create a portfolio you can stick with. So is there anything wrong with having some overexposure to a sector? I suppose not. It's not an approach I've ever taken, but the thing is can you stick with it for the next 30 years? I think most people can't. And so as you think about building your own portfolio with your 401k, your IRA, your taxable account, that's, I think, one of the most important questions you need to ask. Is this an asset allocation, a portfolio that I can stick with for the long term? Now, there may be times when it makes sense to alter your stock bond allocation, right? Particularly, say, as you near and enter retirement. But aside from that sort of asset allocation change, you really ought to think, can I stick with this forever? Is there going to be some reason why this is going to be maybe a type of investment that I'm not going to be comfortable with? And the more specific you get with the type of funds you're buying, right? You think you could start with sort of a total world fund, then you get down to, say, a U.S. or international funds, but then you can get further down into sector funds. I suppose you can get all the way down to an individual stock. The more narrow the investment, the more volatile, generally speaking, it's going to be. Again, not necessarily an issue. The issue comes in where you can't handle that volatility. So you really need to sort of be honest with yourself. Is this something that I can stick with? And I think the Mind the Gap report, which is one of my favorites that Morningstar puts out, really underscores the importance of that. So I wanted to share that with you today. And then number 3, I call it the power of subtraction. I was reading some articles this week that brought this to mind. And here's how it came up. Whenever we're thinking about improving some area of our life, improving our relationships, improving our finances, our work, doing something new to the house, improving just about anything, I think our natural tendency is to ask, what can I add? Who do I need to spend more time with? What additional credentials can I get for work? You want to do something to the living room or the dining room, and it's okay. Well, maybe we need a new piece of art, or we need some new addition to the house to make it better. And there's nothing necessarily wrong with that kind of question, but I think we lose out if it's the only question we ask. And one of the questions I found myself asking more and more and more is not just what can I add to improve something, but what can I get rid of? What's in my family room right now that I can actually, the room could be better, whatever that means for you or me, by taking something out. Maybe there's a relationship I need to cut back on. Maybe, what is it that I can subtract from my life that would improve my life? And I think that has a lot of applications in the world of finances. So I tend to have, they would call it scope creep in the world of sort of project management or software development. But I can have that with money, where it seemed like a good idea, so I opened up a new investment account. Okay, it didn't seem like a bad choice, but you multiply that over the years, and all of a sudden you look at your investments and you're like, what have I done? It's like I've got more accounts than I can keep track of. And so periodically, and I would say it's about once a year, maybe once every other year, I'll go through our finances and I'll ask, what can I subtract that will make our money easier to manage, easier to understand, that sort of thing. And for me, it comes down to a couple of things. I have been streamlining the funds that we own. I'd rather own fewer funds, all things being equal. And so, for example, I moved, this was now about a year ago, I moved out of an emerging markets fund and a REIT fund. Now, those are perfectly reasonable investments. I owned those types of funds for nearly 25 years. I still have exposure to emerging markets and REITs through other funds like a total U.S. stock market fund and a total international fund. But I don't have specific allocations to those asset classes in specific funds. Why? It just made managing our investments easier, particularly, by the way, when it came to rebalancing. It was just, I had much more flexibility. And so I got rid of those funds. Again, nothing wrong with them, but it made life easier. I also tend to avoid certain types of investments because I don't want the added complexity. So, for example, there's a lot of crowdfunding, sort of real estate syndication kind of accounts, like Fundrise would be an example. Again, nothing necessarily wrong with that type of investment, but I'm thinking, do I really, how important is that such that I'm going to add another account to an already complex, financial situation? And can I just, if I wanted that, wouldn't it be easier in a REIT? And then again, I get to the point where, do I even need a REIT? I've already got real estate exposure in the total U.S. stock market fund. Isn't that enough? Again, you may say, no, it's not enough for you. And you may have a REIT or you may have crowdfunding type of investment. But for me, I just don't need that added complexity. Again, going back to sector funds, it just was another complexity that I didn't think I needed. I don't own crypto. Now, I don't own crypto for a number of reasons, but I just didn't want the added complexity in another account, and I didn't want to deal with it. The other area where I do this is subscriptions. I'm constantly going through my subscriptions, not only personally, but also for my business. Because, you sign up for something and maybe it was a good idea and maybe you use whatever the service was for a while, but a year later you realize you're not using it anymore and you're still paying for it. And so about once a year, I just get out the credit card statement. I say, okay, where are all my subscriptions? And can I get rid of any of these and maybe improve my life or at a minimum, not take away from my life, just one, get rid of that expense, but also just the added complexity of having all of these things in our lives. Bank accounts is another one. I mean, we do have a couple of bank accounts, and again, how many you're going to have could vary from how many I might have. But I try to keep it to a minimum, and so for us, it's typically a checking account at sort of a traditional bank. For us, it's always been a large bank, and then perhaps one online savings account where I can get a better interest rate. Now, actually, more recently, what I've done is put our cash primarily in T-bills. So I don't even actually have to have that second bank account because I can buy the T-bills inside an already existing brokerage account. And so I get a safe place to park our cash with right now pretty good yields and no state and local income tax. And I don't have to open up a new account for it. So the big takeaway is, as you're trying to improve anything, I think it's good to ask, hey, what can I add to make whatever it is better? But I think a really important question is to also ask, what can I subtract? What can I get rid of that would make my life better, easier, less complicated, whatever the case may be? And yeah, I thought I'd share that with you this week. And in fact, it's that time of year where I'm going to start going through all our subscriptions, and it'll be like, what was I thinking? Why did I sign up for that? Particularly with my business. I just seem to get into subscriptions and then later I'm like, I don't know what I was thinking. Well, there you go. Hope you have a great week. If you watch this on YouTube and you have any questions, leave them in the comments below the YouTube video. Be happy to help you out any way I can. And remember, send me an email, dr@doorroller.net. Let me know topics you'd like me to cover in future podcast episodes. So there you go. Again, hope you have a great week. And until next time, remember, the best thing money can buy is financial freedom.